Jason Kelly, what is the 3% signal and how can it make me money?
It's a simple way to know what to do on a quarterly basis with your account, usually a retirement account like a 401k or an IRA. It shows you just whether your stock fund has gone up enough in order to sell off some of the excess profit and put it in the safety of a bond fund, or has gone down or not risen enough in order for you to move capital over from the bond fund into the stock fund. It provides a very clear decision point to understand whether stocks are up or down so that you can make the automated decision to buy low or sell high. And that's what the 3% signal is. It's how much you want the growth part of the plan, which is the stock fund, to go up in 1 quarter. That's what it refers to.
And you use small cap stocks for the strategy. Why do they work best?
They are more volatile than large cap stocks, and they've risen more over time as well. So you put those two factors together, and this automated way of taking advantage or really using that up and down motion of small cap stocks works perfectly for this type of plan, which doesn't care about anything except price. It just looks at price. So it takes away all the pitfalls that most people run into. And small cap stocks are perfect for it because by using an index, you get away from making the mistake of putting everything in a hot stock that you really like, and then it turns out to be not so hot. Or you panic out when a company has a bad quarter and the stock goes down. These common mistakes people make can go away by using an index. But this goes beyond just using the index. Using that small cap index plus this plan lets that growth fund fluctuate a lot. You know, if you were in a larger or maybe a dividend paying stock fund or even just a large cap stock fund, you wouldn't get quite as much movement. At least historically you haven't had quite as much movement. But by being in the small cap index, you get a lot of movement but no risk of bankruptcy, and you get a price line that goes way up and way down relative to larger cap stocks, and then you get a clear signal that tells you it's up a lot, so sell, or it's down a lot and buy.
And you've back tested this strategy. Talk about the results that you've seen so far.
So because I use small cap stocks and I want to use the indexes, and I want to use funds that have been in actual existence, so instead of just the raw indexes themselves, I tested it back to 2000. That's when I started the plan with all indexes that still, index funds and ETFs that still exist. In that time frame, we've had 2 big crashes. We had the dot-com crash right around 2000, and we had the subprime mortgage crash. So we had 2 big up and down moves there. And through that period, the plan has beaten the market itself, and it also beats the growth fund that's used in the plan. So in other words, if you're just dollar cost averaging or buying and holding that growth stock fund, you'll do better than that with this plan.
So where should people own it? In their IRAs, in their savings? Because there is a lot of trading involved.
Yeah, there is. It is better in a tax-advantaged account. So 401k or IRA is the way to go. But because there's so little trading, because you don't always sell every quarter, a lot of times you're just buying or moving different amounts of money into that stock fund, it can work even in a regular account, but it is better in a tax-advantaged account just because you don't have to worry about whether you're going to have a consequence by selling.
All right. Thanks a lot, Jason.
Yeah, thanks for having me.
Thank you for watching The Street.